Go for it, Scott.
Great. Thank you, Lindsay. I appreciate everybody taking the time today to join us to discuss the updates to our scoring model and how that impacts the investment reports. This is something that our investment committee spent a lot of time on in the latter half of last year that kind of came together and started to trickle through to our investment reports with the 12/31 investment reporting cycle, and will continue on as we head into this year. And you likely saw in your committee meetings or in your as you reviewed the reports, those changes, and maybe talked at a high level. The purpose today was really to spend more time for those that are interested getting into the details of the changes that were made and why we made those changes. Oops, there we go. So before we start, I guess it's really important, I think, to provide some background as to kind of why we tried to make or decided to make these changes, and importantly, kind of how we use our scoring model internally. For our investment team, the scoring model has really been always a guiding tool for us to kind of orient where the investment team should spend their time and effort trying to understand managers. It's never been something that has been designed or communicated to be a kind of a predictive investment tool, but certainly something that kind of looks at those things that we think are really critical to understand about a manager and kind of guide our understanding if their things score well, understanding why they do, or if there are flags there, understanding what's driving that flag and whether further research is needed. As our committee looked at this over the past couple years, really, one of the things that we've found is that the way that our scoring model had been constructed, more often than not, was creating, it was too complicated in its structure, and that's had us spending more time with clients communicating kind of the intricacies of the scoring rather than kind of the underlying kind of fundamental qualitative things that we think are more important. So as we set out to look at updating and refreshing our scoring model, which we had developed in, I want to say it was early 2007 with a few very modest tweaks along the way, our goals were really to focus on simplifying the model so that it is easier to communicate the substance of what we're looking at to clients rather than kind of the complexity that was built into that. And so the simplification really took kind of form in a few different ways, and we'll talk about that as we get into the individual metrics. First, we standardized the calculation across all peer groups. And that comes into play with a couple of the specific categories that we had, one being investment style, the other being expenses, where we had for some data issues as well as for asset class type issues, created some different calculations for different asset classes or different peer groups. That created a complexity to the model of trying to remember which asset classes were scored in which way based on the kind of what we had set there for the style and for expenses, and just created some complexity. So standardizing the calculations across all asset classes so that we calculate in a consistent manner the scores for all funds. Mentioned simplifying the calculation, so the underlying metrics as well. We look to simplify to the extent possible so that when we see something that gets flagged, it's easier to communicate why that flag is being generated. And then the last kind of area of simplification is that we had a number of categories in our scoring model that were a combination of multiple components. And when that happened and a fund was scored, and maybe a flag was raised, because we're combining multiple calculations, multiple components, it created a lack of clarity as to what underlying calculation, what underlying issue was really driving that flag. So we tried to separate out and added a few different kind of elements to the scoring model that had been there but had been kind of buried under the hood. The second thing we looked at is, we'd quite consistently gotten feedback from clients that, the overlay that we put, the red, green, yellow, model, I think was creating some unease and uncertainty. And the reason for that was we had initially set a pretty high threshold for what constituted a green fund. It was roughly funds in the top third, about 35% of the peer group. Yellow was between 35 and 50th percentile, and red was in the bottom half. What we found is that created a lot of false flags where we were seeing red, and as an investment committee, we could easily kind of, research that quickly, understand what was going on, and discount that if that was an issue. But when we're taking that out and communicating that to clients who aren't as involved in depth with the managers and maybe only looking at our report kind of the 4 times a year we come out to meet, is creating a lot of anxiety and uncertainty. The other thing that we saw is that, if you kind of look at kind of where the industry kind of has settled on a number of things, generally most metrics that you see, other quantitative models kind of say, things that in the top half of their peer group are good. And then if you get into the bottom half, then you start to find some differentiation. The difference between kind of a 49th percentile and a 51st percentile fund's generally not much, but you get into that kind of that bottom quartile and things get worse. So yeah, some of this was also done from kind of how we create those triggers to better align with what we see within the industry, and that's important because the experience that others have with similar quantitative scoring models they bring to bear when we work with them. So, trying to set different kind of expectations there has been a challenge. So as we talk through this, I think the first thing is important to understand kind of the scoring process that we have and how we evaluate these funds every quarter. It initially begins by creating the investable universe. And our investable universe consists of a few different data sets that we kind of merge together into a single universe. We use a Morningstar US mutual fund database that brings in basically all the 40 Act mutual funds in the US. We filter out of that database B shares and C shares. We don't have clients that use those funds. They're not appropriate for retirement plans generally, so we don't score those. We also added last quarter the Morningstar US ETF database. ETFs aren't yet common in defined contribution retirement plans, but we are seeing some interest and movement there, and so we decided to bring that in as part of the investment universe here recently. And then we have the Morningstar US variable annuity database and the underlying funds there, which really covers a number of the insurance company separate accounts that we see commonly in tax-exempt plans that are used in a similar manner to a mutual fund or a 40 Act fund. We also maintain internally a custom database that is products that aren't publicly available, and we gather the same data points that we use from the Morningstar public databases so that we can gather and cover those funds and report on them in the same way that we do the public funds that we have access to in the Morningstar databases. The custom fund database consists primarily of some collective investment trusts, some general account fixed annuities, and non-public insurance separate accounts and stable value funds. One of the things that we're working on this quarter is actually incorporating a public collective investment trust database from Morningstar, so that will be incorporated into our scoring model. But we basically take those different data sets and merge them into a single investment universe of products that our clients may use within their plans. The second step is then to define the peer group. We use the Morningstar categorization data point as the definition of our peer groups. We've chosen that because it's in a lot of ways become kind of an industry standard. It is used by many of the record keepers in the communications they put together for clients, for participants, and we think it's helpful for committees to look with it through the same lens as the participants do in evaluating those funds. The peer group consists of all of the funds from that combined investment universe with the same Morningstar category that have an active return history. Although I would say, while they're all in the universe, our scoring, and we'll get into this in a little bit, generally requires 5 years of performance history to receive a score in certain of our categories, but we include all the funds from that combined investment universe with the Morningstar category. That currently consists of, I want to say it's 70 to 75 different peer groups that we maintain. That number fluctuates to some degree as clients occasionally add a very niche asset. We may build out a new peer group if we haven't had coverage. From time to time, Morningstar also changes their peer group classification. Later this year, they're actually splitting out an intermediate bond peer group that most of our clients have exposure to into a core and core plus bond. So the second step in our scoring process is to define the peer group, and we create those and maintain those every quarter. Once the peer groups have been created, we assign a benchmark at the peer group level, and the benchmark is chosen by our investment committee, and the committee looks at and determining kind of the assignment of the appropriate benchmark. A variety of different factors, including the availability of the data for the index fund and underlying data, how accurately the committee thinks that index represents the peer group or the asset class, and what do we commonly see within the industry that active managers use in benchmarking themselves. Generally, what we find is that we're using the Bloomberg Barclays series of indices for the various fixed income asset classes. You may recall that as being Barclays before it was Bloomberg Barclays, and prior to that it was Lehman Brothers. They've long been a leader in fixed income indexing. Within the U.S. equity asset classes, we're primarily using Russell indices, the one exception being the large cap blend category. We're using an S&P 500 index benchmark because so many of those funds are benchmarked to the S&P 500. And then internationally, we're seeing the use of MSCI as kind of the primary benchmarking fund family for international asset classes. The committee looks at those every year, kind of makes decisions as the market evolves, and there's been some activity with the index fund providers, but those don't tend to change with a great deal of frequency. Once we've assigned the benchmark, then we actually score all of the funds in the peer group using that benchmark. And we have a variety of different categories kind of shown. Expenses is 20% of the overall score. Experience is 10%. Holdings diversification is 5%. Concentration risk is 5%. Style purity is 10. Style consistency is 10. Manager skill 20. Consistency and risk are 10 each. So those are the categories. The green ones that are highlighted there, kind of the new categories, if you will, that showed up this quarter that had not been there previously. Although as we get into the underlying metrics, they're not really new calculations. So just kind of walk through each of those categories and talk about the scoring, kind of the before and after, and what changed and why we chose to do that. Expenses has historically been, a big component of our overall scoring model. In the old version, it was 20%. Currently, it's 20%. The big update here is that, historically we used two different metrics to evaluate expense. For asset allocation and equity funds, we used the expense ratio and the turnover ratio of the fund. And the rationale for that was, we were using turnover ratio as kind of a proxy of the implicit cost that a fund incurs when they're trading frequently, the market impact, the brokerage commissions. We found turnover ratio wasn't a good metric for fixed income funds, so a while back we actually took that out and just used expense ratio. And so this was one of those areas where we had different calculations for different asset classes. And trying to communicate, well, it's this type of fund, so that's what this means is just expense ratio, but it's a different type of fund, so it should be turnover ratio and expense ratio, was pretty complicated. And our committee continues to look at turnover ratio, but ultimately decided that the expenses score, for simplicity and clarity of communication, really was just going to focus on the expense ratio. And so that's one of those areas that we chose to kind of standardize across all asset classes. So what we do now is we rank all of the funds within their peer group based on the prospectus net expense ratio relative to all the others in the peer group. They're percentile ranked, with 1 is basically the best, 100 is the worst. And we use prospectus net as kind of an important. There are 4 or 5 different measures of fees. The prospectus number is a forward-looking estimate of the fees that's published in the prospectus. The net expense is inclusive of any fee waivers, so separate from the gross. We think it's kind of the best measure of what a fund is likely to charge as we look ahead. So in the expense category, it really didn't change the overall weight or how it was reflected. Really just chose to simplify the scoring to make it easier to communicate, and I think still kind of reflect the committee's view, which is we're very much biased to low-cost managers and wanting low cost relative to the peers. As I mentioned, we still continue as on the qualitative basis to look and understand and have kind of a preference for lower turnover managers, but we took that out of the explicit scoring model. But it's something that the committee still looks at. The experience category is one where we basically made no changes. We use the manager tenure of the longest assigned manager, and we assign points from 0 to 10 based on the number of years that a manager has been there. Obviously, if a manager's been there for a decade or longer, they get the full 10 points. Our bias is to managers that have a long-term track record. We think the experience is critical to a fund manager and being able to manage through multiple market cycles. We also think that this is a good measure of kind of how relevant, some of the historical performance is. If we see a fund that looks like it's done a great job over the past 5 years, but the manager tenure is 0, that historical performance isn't particularly relevant to us because the person that posted those numbers isn't there. So we kind of use that in one of 2 ways, but certainly a bias of our committee is to more experienced managers, and we look at that by measuring the experience they have on that fund. It's not the only measure that we look at. We also, when we see manager transitions, we look at their experience managing other public funds and their history. But it's certainly something that we look at in our quantitative scoring model and look to evaluate. This is, I guess, maybe where we start to find a little bit of a difference in kind of the scoring model in the old way and the new way. Historically, we had a diversification component that was 5% of the overall score. And this was, to evaluate that, we had 2 underlying metrics. 1 looked at the number of holdings in a fund, and 2 looked at the concentration of the assets in the top 10 holdings. This was one of those cases where if a fund was flagged for diversification, we were then left kind of trying to figure out, well, is it because they don't own enough holdings or because the portfolio is too concentrated? And so as part of this process, we decided to break those out into 2 separate metrics and to weight each of those metrics as 5% in the overall score. So this was a component that we had historically, if you were to look through, because we had 2 components in the diversification category, and that was 5%. This was weighted to 2.5%, so we increased the weights slightly, but basically kept the same metrics, just created its own category. And so here what we're looking at is, as a measure of diversification, the total number of holdings within the fund. And this is a case where, we weren't able to necessarily quite simplify it to the level we want, but I think we are, we're able to make it a little bit more streamlined and easier to understand. So as we look at kind of assigning points in this category from 0 to 5, kind of the methodology or thought process is a fund of funds is scored 5 out of 5. So a fund of funds sometimes appears in the database. They're mutual funds that invest in other underlying mutual funds. And so as you look at kind of the data that's reported, a lot of times the underlying holdings aren't looking through the funds they hold, but just show the funds that they're invested in. So you may find a fund of funds that shows 5, 6, 7, 10, 20 holdings. And if you don't understand what those holdings are, you may think it's not very diversified. But the funds they hold ultimately add the diversification. So we said, if it's a fund of funds, you get 5 out of 5 points. We also said, if it's not a fund of funds, then we kind of get into the next logic, which is if you have 60 or more holdings, we consider you diversified. There's been some academic research that kind of shows, where, the diversification benefits of adding holdings to the portfolio have a declining value past a certain point. And as we look at the universe and what we're comfortable with, ultimately, if you own more than 60 names, whether it's 61 or 300, we think you're sufficiently diversified to get full points in this space. If you hold between 40 and 60 individual securities, you're starting to test the limits of kind of where our investment committee is comfortable from a diversification perspective. And so you get 3 out of 5 points. It's not that it's kind of negative per se, but it is an indication that this portfolio is likely to be a little bit less diversified in the number of holdings. And we do think that in some ways that's a kind of an indirect measure of risk for investors. And if the portfolio holds less than 40 names, you get a 0 out of 5. There was a time, although I'd say it's not as popular today, where some of these focused or kind of very concentrated portfolios were popular, and you'd find funds that had maybe the manager's best 20 or 25 ideas. Pretty concentrated and volatile from a performance perspective, and not something that we've generally considered appropriate for a defined contribution plan where participants are making the investment decisions. So a portfolio with less than 40 stocks is one that tends to flag as an area of some holdings diversification risk. The second component of our historical diversification score, we use the percentage of assets in the top 10. So rather than looking at how many individual securities are in the portfolio, we basically looked at how concentrated the portfolio was in a handful of names. Again, this was 2.5 out of the 5 points. It's been increased to 5 points, or 5% of the overall score. And basically what we're looking at is the top 10 positions in the fund, what percentage of the overall portfolio are they? You can have cases where a fund has a very long tail of minuscule positions, but is very concentrated in a few holdings. And so it's a different view of kind of the potential risk that comes from a lack of diversification or concentration in the portfolio. In this case, basically, we set some thresholds. The lower the percentage of assets in the top 10 holdings, the better. So if it's less than 25%, you get 5 points. If it's 25 to 35%, you get 4 points. 35 to 45%, 3 points. And if the top 10 names are more than 45% of your portfolio's assets, you get 0 points. Another kind of just an indication of some risk there. Not that it's necessarily any of these individual metrics are a disqualifying event from us recommending a fund, but something that if we saw that type of flag, we certainly want to understand better why that is and how the manager may mitigate risk that comes from that. So those first set of categories that we looked at are all kind of point-in-time evaluations of the fund based on kind of the data that's available at any given quarter end. The expenses, the tenure of the manager, their holdings, and percentage of assets in the top 10. We then get into kind of some of the historical performance-based metrics that we use to evaluate the style, the skill, and the risk of the manager. And the first of those being style purity. If you're familiar with our investment style, with our scoring model, you'll recall that historically we had investment style as a category that was 25% of the overall score. And this is another one of those cases where the style metric was a combination of two factors. The first being style purity and the second being style consistency. So style purity was, in the old model, 15 out of the 25 points. Because we increased the weights of the diversification and concentration risk, we had to take that from somewhere else. What we chose to do was decrease style purity from 15 to 10%. So we reweighted it slightly. We broke it out into its own column. This was another category where we used separate metrics to calculate the style purity score based on different the different asset classes. So for the U.S. equity and international equity funds and asset classes, we used a returns-based style analysis style map, kind of the tic-tac-toe box that you maybe are familiar with from Morningstar, but using a returns-based methodology. And we basically calculated whether a fund kind of fit in the tic-tac-toe box that we thought they should based on the peer group. That model worked for U.S. equity funds and international equity funds, but didn't really work for sector funds, for fixed income, for asset allocation funds. So we used a simple measure of R-squared versus the benchmark for all the other asset classes. Another area where created a lot of complexity: which measure are we using? How should we look at this? So for simplicity, what we chose to do is to switch all of the peer groups and asset classes to use R-squared versus the benchmark. So R-squared is just a measure of kind of how well the benchmark's returns, the volatility of those returns explains the volatility of the returns of the manager. Do they move kind of in tandem generally over time? The score can be between 0, which basically means it doesn't explain the returns of the fund very well, to 100, which means it explains it kind of perfectly. And we calculate the R-squared of the fund versus the benchmark that was assigned to the peer group over the last 60 months, 5 years. And the R-squared value is basically if it's greater than or equal to 90, you get 10 points. If it's greater than or equal to 80, you get 8 points. If it's greater than or equal to 70, 6 points. And if it's less than 70, you get 0 points. This specific category is one of a couple, the experience category being another, where we chose to create some absolute thresholds versus relative peer thresholds. And the reason that we did that is, as we looked at the data, we thought the absolute thresholds of 90, 80, 70 for R-squared were a better measure of kind of how style pure a manager is versus doing a percentile rank, which is what we do for things like expenses and standard deviation that you'll see later on. The second component of our historical investment style score was style consistency. This was 10 out of the 25 points historically. It continues to be 10 out of the 100 points in the total, so there was no change in its weighting. And we're using the exact same measurements as before, so we didn't really change anything here. We just broke it out and put it into its own category to create a greater transparency. So we use it here, a statistical measure called style drift. It measures the deviation of the fund's asset weights that were calculated using the returns-based style analysis methodology. Again, we're using a 60-month window. I think I mentioned in the past. You kind of need that 5 years of history. It's because for many of these performance metrics, we're using a 60-month window. And then funds get a style drift score, and then they're ranked basically first percentile to 100th percentile. The lower the style drift score, the better, more points that they get. So this one's kind of a hard one to explain. So I think it's helpful to kind of visualize what the calculation, the style drift calculation is doing. And so what we have on top is a style analysis of two funds, the low style consistency fund and the high style consistency fund. The low style consistency fund, you can see, is a portfolio that started primarily with large cap value securities. As they move forward in time, they seem to kind of transition the portfolio more to a small cap value portfolio and added some international holdings to it. So the style consistency changed over time. It's an active fund. The decision making of the manager to make that transition, it doesn't really much matter in this case, but certainly the manager kind of changed where they were investing in the portfolio. The high style consistency fund, in this case, actually is an index fund. So, chosen mostly to show contrast, but you can have active managers that show high style consistency as well. You can see as a large cap value fund, it stays a large cap value fund over time. So style drift basically measures the volatility of that area graph up above. And you can see down below the style drift score for the low consistency fund is about 35%. It's practically 0 for the high style consistency fund. We take that style drift score, we rank you, lower is better, you get more points the lower your score is. So style consistency is really just trying to measure, regardless of how pure the manager is, whether they're investing in the asset class we want, are they consistent in their exposures? And this kind of ties back, both style purity and style consistency can tie back to kind of the philosophy of the committee, which is in a defined contribution context, which is where the vast majority of our clients are using these funds. We think it's really important for participants to be able to have some certainty when they buy a fund that is communicated as a large cap growth manager, that they actually get large cap growth exposure. And that's because asset allocation and that asset exposure is such a determining factor in the expected returns and the expected risk. We think it's really important, and most participants aren't looking through to understand holdings and style drift. And so we think it's important that the manager is pure to the style that they state they're going to be, and that they consistently stay there and don't drift around. It also comes back specifically with style consistency to a belief that we don't think market timing moving into and out of asset classes is a very successful way to add value consistently over time. Our bias when we're using active managers is to use managers that can add value primarily through security selection, which usually results in consistent style exposure, but better security selection within the style that they've chosen. The next component is manager skill, and here we're using 3 underlying components. And before I kind of dive into this, what I'll say is as much success as I think we had in simplifying kind of the other components of our scoring model, this is an area that we acknowledge has a lot of work to be done to better simplify and communicate what we're measuring. Our committee continues to work on this, and I would expect that sometime this year into maybe early next year, we may see some further updates here. We didn't make any really significant changes to this, but it's certainly an area that that continues to have a greater degree of complexity than we desire. So the 3 components, though, that we look at in manager skill are excess return, which is really the difference between the manager's return and the benchmark return. Did the manager do better or worse than the benchmark? Kind of the simplest measure. Security selection return, which is, we use that style model that we talked about and have used elsewhere to create a custom benchmark that reflects the manager's style. And then we compare the manager's return to the style benchmark return. The difference is really attributable to kind of the security selection within the style exposure that they have. And then lastly, alpha, which is kind of a multi-factor regression analysis of whether the fund does better than expected given their style exposures. In this case, the total is 20% or 20 points possible. Those 3 components are averaged, so each is worth a third. And this was an area that we made some pretty significant changes, not to the metrics, but to how we scaled those and incorporated those into the scoring. So historically, what we did in the manager skill category was basically said 0 points out of 20 as a neutral value. Index funds were assigned 0 points, and we basically used 0 as a starting point. Then we measured whether a manager added value, and if they did, they could earn up to 20 points possible if they had across these 3 metrics value add. And if they didn't, they actually were subtracted points with the potential of losing up to 20 points. So by kind of centering around 0 as the neutral value, we created a category that actually could swing point totals, plus or minus 40 points because of the positive to the negative extremes. And so it kind of overweighted this category relative to everything else and created a lot of volatility in the scoring for funds kind of around the zero, where from quarter to quarter, their metrics might go from slightly positive to slightly negative. So what we chose to do is kind of recenter the scoring as kind of a neutral value around 10 points, so that the range of outcomes in this category could be 0 to 20 points. So index funds now are assigned 10 points out of 20. They're reflected on our scorecard as not applicable or not available in index, that we're not scoring them. They get 10 out of 20 points. But then active funds can score from 0 up to 20 points based on their metrics. And so, again, what we do here really is for each of those individual components, we calculate the value for the past 60 months. So we'll use excess returns as kind of the simplest example. We look at the excess returns of the fund for the past 60 months. If that excess return number is positive, a fund can score between 10 and 20 points based on how positive that value is compared to all the other peer groups. If the excess returns are negative, they can score from 10 down to 0 points, depending on how negative that number is relative to the peer groups. So in this case, for each of the components, there's kind of a two-step method. First, did they add value in that metric? Was it positive or negative? And if it is positive, we then scale it relative to its peers to determine between the 10 and 20 how positive, and vice versa for negative. So you can, based on your percentile rank, if you have positive excess returns and the excess returns are better than everybody else in the peer group, you get 20 points. If you have positive excess returns, but everybody in the peer group has positive excess returns and you're the worst percentile, you may get 10 or 10.1 points. We calculate that number, those points, for each of the three components: excess returns, security selection, and alpha, and then we average those together. An example of this is a fund that we looked at that has, you can see for the last 60 months, positive excess returns of 0.24%. Those positive excess returns put the fund in the 30th percentile of its peer group. And so it gets, because it's above average and has positive excess returns, it gets a total of 17.1 points out of 20. Its selection return, so using the manager's style and creating a style index that matches that style and then evaluating the manager's returns, shows that the selection returns were actually negative 0.89%. So while the fund outperformed the benchmark, by adjusting for its style, it actually didn't add value during this time frame. That put the fund in the 52nd percentile, so basically average, slightly below. But because it's negative, they kind of work down from 10, and so they only got 4.8 points in selection return. And then the last measure, the alpha, kind of the overall encompassing, did the manager do better than we expected given its style exposure, was a positive 0.27%. Again, about average in the 47th percentile. So in this case, they score 15.4 points. So there's still some big impact you can see from whether the returns measured in any of the categories are positive or negative. But then we scale it relative to the peer group. So the difference between a 47th percentile alpha score that's positive versus a 52nd percentile security selection score that's negative is about 10 points. That's, in the old model, maybe it was 20 points. But we average those 3 point categories, so the fund scores an overall value of 12.43 out of 20 points. As probably you can pick up from that discussion, is still a lot of complexity there, and things that we're looking at. How do we better simplify and communicate kind of whether we're thinking a manager adds value or not, and more to come on that. The next category we look at is consistency. In this case, consistency is really just a measure of the frequency with which a manager has positive excess returns. It's called batting average. It's a pretty common investment metric. And the idea is each month is an at-bat. So how many at-bats do we have? And a hit is, each month where we have positive excess returns. So in this case, we use that same 60-month window. And so we say, okay, we have 60 at-bats. How many of the months did the manager have positive excess returns? In this case, we don't care if it's positive 0.1 or positive 10%. We just want to know that they outperformed in that 1 month. If they outperformed in 30 out of 60 months, their batting average is 500 or 0.5. A higher batting average is better. We like managers that can consistently add value. And one of the weaknesses of looking at past performance is, you may find cases where a manager has one short period of significant outperformance that impacts kind of all of the trailing returns. So we're looking for managers that can consistently add value with the belief that they're more likely to repeat that in the future than the manager that, one time 3 years ago swung for the fences, doubled their portfolio relative to the benchmark, but hasn't been able to replicate that success. In this case, what we do is we calculate the batting average for each of the funds. We rank them relative to the peer groups. First percentile is the highest batting averages, 100th percentile is the lowest batting averages. Higher batting averages get more points. Pretty straightforward. This is one measure similar to manager skill where we do a slight difference for index funds. They get a similar kind of reflection of the NA index on the scorecard. And the reason for that is index funds generally have really low batting averages. And so they don't score well in this case, and we don't think it's actually a very relevant metric since we don't expect an index fund to have positive excess returns. In most cases, in any given month, an index fund should track its manager less the few basis points for its fees, and so it should never kind of have positive excess returns. So its batting averages tend to be close to zero. In many cases for an index fund, if they have a positive excess return, it means they're probably not matching or tracking the index very well. So we kind of pull out index funds and kind of reflect that on our scorecard that they're not scored in this category. And then the last component of our scoring model is risk. In this case, there are a million different measures of risk. We've talked about concentration risk and diversification, and I think you could look at style as some other indirect measures of risk. In this case, really what we're talking about is standard deviation, or the volatility of a fund's returns. It's a pretty common measure of risk for investment managers to look at standard deviation. This is how we've always kind of scored it. We look at the fund's standard deviation over that same 5-year window. Lower standard deviation is better. We rank all the funds relative to their peers, and you can score basically between 0 and 10 points based on the volatility that you have. So pretty straightforward metric of risk and no real substantive changes here in how we evaluate that. So that is the scoring model, the underlying calculations and metrics that go into our score of all the funds. And we calculate that for all of the funds in all of the peer groups each quarter. It's probably 25 to 30,000 individual funds that we run through this scoring model and get values from. And there's data there to support that. The second thing I'd mentioned back to kind of what we do and some of the changes we make is overlaying those point values and those total scores is the triggers and kind of the conditional whether something it shows on our scorecard is green, as yellow, or as red. And we made some updates there to try and simplify this as well. And so what you can see here is kind of how we've updated the scoring threshold. So if you look, and I'll just kind of walk through each of those categories again, for expenses, if the fund is greater than or equal to the 50th percentile, it scores green in the scorecard. 51st to 75th percentile is yellow, and the bottom quartile is red. In many of these places, we tried to use a similar kind of consistent methodology. So that top half green, third quarter yellow, fourth quarter red, we use for expenses, for consistency and risk, to make that a little bit simpler. We also use that for style consistency. So that top half, third quartile, fourth quartile kind of methodology we use across a number of those categories. A couple other cases where that doesn't really fit. For experience, if you have greater than 5 years of experience, you're green. If you have 3 to 5 years of experience, it's yellow. And if it's less than 3 years of experience, it's red. Holdings diversification greater than or equal to 60 holdings, or a fund of funds is green. 40 to 59 is yellow. Less than 40 is red. Percentage of assets in the top 10 holdings, if it's less than 35%, green. 35 to 45 is yellow, and greater than 45 is red. R squared greater than or equal to 80 is green. 70 is yellow, and less than 70 is red. And then kind of the other outlier, I guess, back to the comments I had about manager skill. Basically, we're looking, saying if you have positive absolute metrics in excess return security selection and in alpha, and they're better than the 50th percentile, it's green. If you have positive values, but they're less than the 50th percentile, so you underperform the peers, you're yellow. And if you're negative absolute values, so if you didn't add value for excess return security selection in alpha, it doesn't matter if nobody else in your peer group added value or not, and you did better than all of them, you show up as red. So we try to standardize to the degree possible and simplify where we put those cutoffs, with the expectation that kind of above average in most cases is going to be green now. Third quartile, which tends to, not fall far from kind of the 50th percentile in many cases, is yellow, and that bottom quartile of options, which tend to be the greatest outliers, is red. And we think that better reflects kind of where clients should kind of see and ask questions or see cause for some concern. Again, though, I always kind of want to caution, and when I talk to clients about this, red doesn't necessarily mean bad. I think for us, what it means is we need to understand why that is red and make an informed decision about whether that is an issue for us, yes or no. And a couple examples I'll point out where that comes up. In experience, we see manager transitions frequently where, they can go well, they can go poorly. So if the manager, we found out, decided today to quit and they're out, and they bring in a new manager, that new manager has a tenure of 0, and they were, an analyst that's never managed a portfolio before, it's a cause for concern. In other cases, we see manager transitions where a manager is going to retire in 18 months. They appoint a co-PM who's come from a smaller fund. He has a proven track record, or she has, experience managing these assets. And we look, and there's an orderly transition for 12 months where they share kind of responsibilities, with the expectation that the newly appointed portfolio manager is going to take over. In that case, when the existing portfolio manager retires, the new portfolio manager, there may be a flag for experience, but as we look at their track record and the transition, we're comfortable with that and not necessarily causing cause for concern. Other cases, examples we've seen are risk is a good measure, in certain asset classes over a 5-year time frame. The difference between a top half manager and a 75th percentile manager in terms of volatility can be, tens of basis points, not very significant. And so, there's the context that comes with that as well that we look at to understand what's driving those numbers. So, we think this better reflects kind of where questions should be raised and information, should be communicated, but red doesn't necessarily mean bad. Still, it just means there's something we need to understand and be able to communicate to clients. With that, I appreciate, again, everybody taking the time today to go through that. I don't see any questions. I'll hang out for a couple minutes if anybody does have any questions. Again, thank you for taking the time. We will send out a recording of this in the next few days. A lot of times these questions don't come up because you're not looking at your investment report right now, but they may come as you get into the next quarter, or you just start to think about this. If those questions come up, certainly feel free to talk to your consultant, and they can maybe answer some of those, or certainly I'm happy to talk with anybody and answer any further questions as you review that. Again, kind of coming back to why did we make these changes? Really what we're trying to do is continue to simplify and more accurately communicate information to clients. And we think the changes that we made makes it easier to communicate the substance of what we're looking at rather than kind of the complexity of the scoring model that was there historically. Okay, with that, I'm not seeing any questions. So thanks for your time again, and we'll end the webinar.